To sell or not to sell? And that is the million-dollar question for today. So I think this video will just be an extension from the previous one that I've just uploaded, where I essentially outline my thoughts on where the market is currently going and what I'm doing with most of my positions today. So I think one of my viewers actually hit me up with an email, and I'll just briefly go through with you what was his questions and what is my answer, and maybe also to share with you my experiences in terms of selling some, if not most, of my positions in my portfolio. And you make your own decision. And I would just like to put out a disclaimer right here. There is no correct answer, because I believe that, at least in the investment world, there's a lot of contradictory statements. There are some that say that, oh, there's a lot of opportunity costs. You have to prime yourself into taking profits from certain positions that you don't think that there is any significant upside left, and to reallocate to more higher conviction or higher probability positions. On the other hand, there are also another camp of people that talk about investing probably like the great legends like Mr. Buffett himself, where he held on to positions like Apple, Coca-Cola, and stuff like that for a great deal amount of time, and he just allowed for many of these companies to just compound over time. And especially when you actually hit onto the jackpot, you can get 5x, 10x, even 100x returns. And I think I just wanted to shed some light and to provide my opinion on this particular discussion. But I'd like to say that I don't think there is a correct answer. There is no model answer for any of us to learn as well. So it's just a discussion. So of course, before I begin, feel free to smash that cute little like button. And also leave in the comment section down below on what's your perspective on taking profits. Hey King, how are you going? I'm not going anywhere. I'm still here on YouTube. Hope good in Singapore lah. I believe that he came to Singapore before. It's just a Singaporean slang. So I'm based in Australia. My question is when to take profits. Can you please discuss in your next video what is the anticipated price for all these stickers to start taking profit in blocks, and blocks of how many? So you can also share example of my portfolio if you want to relate to it. We need to bring some positive vibe that it is certainly possible to make money in stocks, and a lot of people still hold negative sentiments. I like your current portfolio. It's high value, but still too many stocks. As you can see, I'm a big effing bull on Baba as well. I don't do margin trading at all. It's all cash. So I like concentrated bets and no more than 5 stocks. What do you think? So I think for some of you, you guys might be interested to know what this particular gentleman has in his portfolio. And I'll just quickly show you because he did attach a screenshot in his portfolio. So you can see that it's an extremely concentrated one. And Baba do have an overweight in the entire portfolio position. So he currently have around 30,000 worth of Baba, and his average price is around 97. So it's definitely in the green. Unless Baba does something crazy and it goes back down to sub 60 again. But if not, I think these 3 main positions that he has, Alibaba, JD, and Alphabet. I happen to have 2, which is Baba and Alphabet. I don't happen to have JD. It's a topic for another day. But just to circle back to this entire discussion, really on the idea of what's my anticipated price for many of these stocks, and when am I going to start taking profits, and if I am, in what blocks, meaning how much do you sell at what price point. Maybe you sell off 10 every $10 increase and stuff like that. So I think, just to put some perspective, he did share of his own target prices. He said that he don't take profit until Baba reach 180, Alphabet reach 175, EWBC 78. I never really follow that, and JD at 85. So I think I just wanted to point out maybe some blind spots or some dangers when you set this kind of target prices in mind. So first things first, it doesn't really take into account the context of basically how the company is trading in the real environment. Because let's not forget, you're actually owning businesses. Behind all this ticker symbol, BABA, there's a real business generating profits, generating cash flow. So I also do agree that, hey, fundamentals of stocks don't change overnight, especially for many of these big companies, and they have like hundreds of billions of dollars in terms of market cap. So the people won't just suddenly tomorrow, nobody uses its platform anymore. So a lot of all these developments happen across different quarters, over years in fact. And I think just an example for Buffett himself, the other time I've forgotten what was the year, he actually entered into IBM. So as we all know, IBM is also a cloud player. It's in some tech consulting space. But back then, it was one of the big brothers out there. I think it has one of the highest market cap as well. And Buffett knew that, hey, the fundamentals is not going anywhere. Revenue was not growing. I think they were trying to optimize income, but there was really not much growth moving forward. That's why he deemed that the fundamentals of the company changed, which is why he sold out of the company. So I think personally, for me at least, from my perspective, I have 3 main criteria for me to sell. Firstly, it's the fundamentals not being intact. You see that, revenue starts to go negative, there is not much growth moving forward, and the management starts to find a lot of excuses, even though it's a booming economy. Maybe if you say that, it's a recession, within the 1 to 2 years, the company is experiencing some sort of headwind, maybe you can give the benefit of the doubt. But even in a booming economy, in a booming industry, and the company is experiencing some sort of negative growth, then that is probably a call for concern. So the first point, fundamentals changing. On the second point, I'll probably take profit when I think it's egregiously overvalued. And by that, I mean you really need to sit down and to do your own valuation work on the portfolio of companies that you own. And by being egregiously overvalued, I don't just mean that, maybe the company is at fair value territory and stuff like that. So for example, let's say take Baba in this case. So usually when you have a valuation framework, you do have a range of figures. There is no one accurate or precise number to look at every single company. So let's say Baba trades in the range of 150 to 180 and you deem it to be fair value. So if Baba today trades at 200, would you take profit? So unless that it's egregiously overvalued, when I key in crazy level of assumptions into my model, and it still doesn't kick back today's prices, then maybe that's when I will consider taking profits. And number three, if you need the money. So of course, if life circumstances change, you need money urgently, you can liquidate your position. So this is my three main criteria on when I will take profit. So back to the dangerous point on why I wouldn't set this kind of profit-taking target. Firstly, it's really the idea behind you are not taking into account the context or how the business is doing. It's purely because let's assume that if Baba really trades back up to 180 to 200, that is also probably when the market starts looking optimistic again. Maybe in the Chinese market, consumption starts picking back up, advertising is also picking back up, the regulation has already been loosened, and it might be a booming decade ahead. So if it is a booming decade ahead and you're expecting growth, and maybe from Baba's perspective, it suddenly reverts back to a growth company, would you want to take profits? Considering that Baba is trading around 150 to 180, which is the fair value territory, but you told yourself that, hey, I'm going to take profits at $180, so that's why I must definitely sell. So it's quite counterintuitive, which is why I don't really understand why people set this kind of profit targets, unless you're trading. But if not, if you are intending to hold really for the long term, then I don't really see a point, especially when you are invested in many of these compounders. And I think in my humble opinion, I think both Baba and Alphabet are considered compounders, at least in my own dictionary. But I think the bigger perspective here is really the investment psychology of many investors. And I do really understand why people want to take profits. Because they essentially want to lock in their gains, and they're afraid that, let's say Baba rallies back to 180, and then because of poor fundamentals, it was the last breath. It went up to 180 and then it crashes back down to $60 or something like that. And then investors will be beating themselves up because they could have taken profits at 180, but they didn't, and now they're stuck with under 100 or under 60, which I understand why and I can relate to it. So really, there is one other perspective where a friend recently shared with me. He said that, hey, if Baba actually doubles from an initial cost price, you can actually consider taking 1/3 or half off the table, and then the rest is just house money. So you allow for it to run and just participate on any further upside. And if Baba happens to crash after you taking profits, then sure, it's free anyway. I mean from the perspective that, hey, you got it for free. I think that's a fairly interesting methodology, especially for those of you who hold on to many of these positions and cannot sleep well at night because you're constantly afraid that these positions will go into nothing or turns into fairy dust tomorrow. At least personally for me, at this current price point of around 100, I honestly don't bother looking at the portfolio or don't bother initiating any buy or sell positions. Not buying because I've kind of allocated fully, but not selling as well because I still think that the valuations are dirt cheap. But if not, for those of you who have initially over allocated to some of these names because it's heavily undervalued, you can consider taking small profits in small chunks when the stock price start appreciating. I think nobody's going to fault you for that. So I think just to really end off this discussion, I'll just share with you my own experience in terms of taking profits. So for those of you who don't know, I've actually started investing, I think, back in my army days. That's around 5 to 6 years ago. I was purely invested in the Singapore market because back then, I think it was still pretty tedious and challenging to be investing in the US market. You have to pay some sort of monthly fee, inactivity fee, and fees here and there. And then there were a lot of dinosaur brokerages. So I didn't really have any access to all these zero cost, low cost commission brokers. And yeah, for those of you who are interested, links to many of these brokerages are in the description below. But anyway, I was invested in the stock market. I bought all the blue chip Singapore stocks. I think mainly I had Keppel and DBS. So back then, I really sold out of the position. I think it was in late 2020 or after the COVID crash recovered. That was when I sold out my entire Singapore position. It's really the proliferation of these brokerages and also this excitement amongst my own friends about investing in the US market. Everybody was saying that, oh, Singapore market was a dinosaur. It's a lot more volatile. There's a lot more opportunities in the US market, which was why I liquidated my entire Singapore position and I switched over to the US counters. And that was when I bought all your big tech, your Apple, your Microsoft, your JP Morgan and stuff like that. So back then, I think they were still relatively cheap. I think Apple was still around $100, $120. Microsoft was, I've forgotten what was it, but it was still very cheap. I think comparatively speaking, a lot of these big tech counterparts are at astronomical numbers now, even though some are still undervalued, which is the ones that I'm currently holding. But let's not go into there. So that was when I switched over. That was the first switch. And the reason for selling was really a reallocation of capital. And not really because these companies have changed fundamentally. Maybe you can argue that Keppel, because it's in an oil and gas industry, it was kind of affected by many of these headwinds. But I think for DBS Bank, back then, if I held true, I think I will also be sitting on like handsome profits. And would I be considering to constantly thinking about opportunity costs? Oh, I must allocate my capital to the highest yielding investment instrument? I don't think so, because as long as you land yourself on good compounders, I think the companies will reward you in the long term. So then, the second time that I sold was really the transition from many of these US big tech to Chinese big tech, because you do know that I'm hugely biased now in this space. And this again, on why I sold, I think back then Apple, when I sold, was around 130, 140. I don't think it's egregiously overvalued, but I did sell or reallocate again because I had limited funds and I did find another opportunity, which is in this case Chinese big tech, and I was stuck since then. I think I started entering into Chinese big tech at end 2020, but then I made the switch over from many of these US big tech as well, because I had limited capital. That's why I needed to reallocate more capital because it kept going down, and this was throughout 2021. So yeah, I didn't sell at the peak. I don't even think I sold at near the peak. It was just on the way up, and then I sold, I reallocated, and I was stuck back holding Chinese tech since then. So I think, at least speaking from my own experience, as long as you kind of know what you're doing and you're picking fundamentally strong companies that are compounders, hopefully in the next decade or so, I really don't see a very compelling point to quickly take profits and to faster cover as long as you break even, or maybe after just a 10 or 20% profit. I don't think that's how investing should be. But of course, I'm not prescribing to you that, oh, I know what's the correct way. That's just how I would like to look at it. And at least in my own defense, back in 2020, 2021, a lot of my positions in the Singapore stock market and even in the US market, my positions were small, which is why I really had very little capital to move around, which is why I need to keep selling and to jump onto the next opportunity. But right now, given my current huge concentration and my position exposure, like Baba and Tencent, even if I were to take profits, I've learned my lesson. I'll probably keep some to let it continue compounding, especially if you pick fundamentally strong companies. And I think there is also a common misconception. I think many investors are missing this point on Alibaba. Stay tuned, stay subscribed. I think in my next video, I'll be talking about what everybody is missing on Alibaba specifically. With that, I'll see you in the next video. But more importantly, I'll finally see you on the moon. Goodbye.